Good morning and welcome to Capital Sound. The contradiction today is loud. Oil screaming crisis, yet stocks barely flinch. I'm Mandy Prince, and with me today is Bernard Gray.
Good to be here, Mandy.
Quick snapshot before we dive in. Major indices were roughly flat to slightly lower on the day. Volatility stayed calm in the low teens, and energy led while growth heavy sectors lagged. Yields edged a bit higher, and oil remained elevated. Those are the numbers. The real question is why the market seems so composed. Bernard, how can oil scream crisis while stocks shrug? Are we misreading the patient or the pulse?
My thesis is straightforward. This calm is a trap. The market is treating oil like a one-week flu when the patient already had pneumonia. Inflation was sticky before this shock. Energy just makes the fever worse. If we apply the margin of safety principle, equities are not pricing the higher for longer path that follows.
That's a strong claim. Walk me through the logic, but keep it in plain English. What makes this a trap?
The principle, then the math. The principle is simple. Higher input costs compress margins and can lift discount rates. The math is that equity value is the present value of future cash flows. If either cash flows shrink or the discount rate rises, value falls. Oil at these levels raises costs and stokes inflation expectations. That pushes rates higher, which compresses multiples. It's not a guess, it's arithmetic.
So your argument is higher oil hits profits and lifts rates, and both squeeze valuations?
Exactly. The rational investor does not treat an energy shock as a temporary headline when inflation is already stubborn.
You're leaning macro. But I want to challenge you with something a lot of listeners hear from traders. This is just positioning and hedging, not fundamentals. They're saying flows are asleep, so the market feels calm. How do you respond?
I hear that a lot, and to be fair, I don't dismiss flows. But I do push back on the idea that microstructure can outrun fundamentals for long. Short-term pricing can be distorted, but fundamental math wins eventually. I've seen this pattern before, early 2022, for example. The market rallied into a tightening cycle and then repriced aggressively as inflation didn't fade. This feels like that.
Hold on, microstructure is a term that people throw around. Translate that for listeners. You're saying market plumbing, who has to trade versus who wants to trade, can mask the real news.
That's exactly it. It's the mechanics of trading, what hedgers need, what risk parity funds must do, and who is levering or delevering. It can mute price moves temporarily, but it doesn't remove the underlying economic impact.
So even if flows are asleep, the math catches up?
It does. The margin of safety exists because humans are fallible. When the crowd ignores math, the math doesn't ignore them.
Here's where I want to press you. If inflation is already sticky, and now we add an oil shock, that sounds like higher for longer to me. But does that automatically mean the equity calm is wrong? Could the market be looking through the shock?
It could be, and that is the counter-argument. The market might expect the shock to fade quickly, but that's precisely why I call it a trap. I'm not saying equities must crash. I'm saying the odds are skewed against complacency. For the market to be right, the energy spike must be brief and have no second-round effects. That's a tough assumption given global supply chains.
Let's unpack second-round effects. For someone not deep in inflation math, what does that mean?
First round is higher gas and energy bills. Second round is when those costs show up in broader prices, manufacturing, shipping, consumer goods. When energy stays high, it seeps into everything. That pushes core inflation higher, which makes it harder for central banks to be patient.
So you're saying we already had pneumonia, inflation was sticky, and now oil is the flu that could push it into fever?
Precisely, and it forces a more aggressive policy stance than equities are pricing.
Let me challenge that. We've seen energy shocks before, and sometimes the central bank looks through it. If the next inflation reading is cool, could the market be vindicated?
It could. A cool reading would allow policymakers to be measured, but to base your equity exposure on a single data point is not a disciplined approach. In value investing, we don't assume the best case. We demand a cushion.
That's a great point. And to be clear, you're not giving advice, you're giving a framework.
Right. The framework is patience. This is the kind of environment where reducing the number of decisions you make is itself a strategy.
All right. Now, I want to bring in the other view because a lot of people are talking about market positioning. The idea is the calm isn't because the news is fine, it's because hedging hasn't kicked in. Do you buy that?
I do, but I see it as reinforcing, not replacing, the macro risk. Let me illustrate with a calculation, conceptually, not with exact figures. If volatility is priced to fall in the months ahead while the underlying risk remains, that's a mismatch. It can create a hedging vacuum. When that vacuum breaks, you get an abrupt move.
Translate that, options markets are pricing calm later, and that can make the next move more violent.
Yes, if too many people assume calm, they don't hedge. Then any sustained shock forces a scramble. It's a structural fragility.
That feels important. We're seeing oil high, geopolitical tension unresolved, but the market is pricing serenity down the road. That's a mismatch.
It is, and I'll add a human moment. I got burned by this exact setup in 2020. Calm pricing, underestimated tail risk, then a violent repricing. It taught me to respect the asymmetry of complacency.
You're weaving in both the macro and the market mechanics. Let's build on the deep dive. Was inflation already pneumonia before the oil flu?
Yes, core inflation had proven sticky even as headline numbers moved around. Wages were firm, services inflation remained elevated, and global goods prices were not deflating as expected. That's a fragile baseline.
And now energy could reignite global goods prices.
Exactly. If energy costs stay high, factory gate prices globally can turn positive again. That flows into imported goods. When that happens, it's not just a transitory blip, it's a policy problem.
That's a strong chain. But I want to stress, we should be careful about specific data points we don't have. So in plain language, you're saying energy feeds through to products people buy, and that makes it harder for inflation to cool.
That's the simple version, yes.
Let's bring in one of your metaphors from earlier because it sticks. You said the market is treating oil like a 1-week flu when the patient already had pneumonia.
Yes, it captures the pre-existing fragility. A healthy patient can shrug off a mild illness, a vulnerable one cannot. Inflation is the vulnerability.
Okay, but we can't ignore the other metaphor floating around. This is a market trying to surf a storm surge with floaties. If we translate that, it sounds like risk is being managed with superficial tools, not real protection.
That's a fair translation. The floaties are cheap hedges. If those hedges are cheap because volatility is priced low, then they are not robust. You can stay afloat for a minute, but the surge wins.
This is where I want to pressure you. If it's so obvious, why are equities calm? Markets aren't dumb.
Markets aren't dumb, but they are human. There's an incentive to believe the shock is temporary. There's career risk in being early, and flows matter in the short term. Those forces can delay the repricing. The market eventually weighs true value, but not on a neat timetable.
Now we're at the surprise part. Options markets seem to be pricing lower crude volatility months out, even as the strait remains closed. If options say calm later, does that invalidate today's fear or set up a snapback?
Risk. If the shock fades quickly, the calm will look wise. But if the shock persists, the low vol pricing creates a hedging vacuum. In that case, the move can be abrupt and disorderly.
So the calm could be false comfort, and that's not the same as predicting a crash. It's a warning about fragility.
Precisely. I am not predicting a collapse. I'm saying the margin of safety is thin.
I want to pivot to a micro test of risk appetite, Tesla as a canary. The question is this the first crack in the risk on veneer?
It might be. Tesla represents growth sensitivity. When growth names start to de-risk while defensives and energy gain relative strength, that's dispersion. It suggests investors are not embracing broad risk. They're making selective choices.
Translate dispersion for people. The market is splitting. Some sectors do okay, others fall behind.
Exactly. It's a segmented market. In a healthy risk environment, many sectors rise together. Here you see pockets of strength and weakness, which is consistent with caution.
So in your framework, Tesla's action is a signal, not a verdict, but a hint that the easy risk-on narrative may be fraying.
Yes, it's not definitive, but it's an early canary. Growth tends to be most sensitive to higher rates and margin pressure. If rates are repricing, growth feels it first.
You're putting a lot of weight on rate repricing. Let me be specific. How do you connect a higher terminal rate to equity multiples without using jargon?
Think of a company's value like the price of a long-term bond. If interest rates go up, the present value of future cash flows goes down. That's the basic relationship. High-growth companies have more of their value in the distant future, so they're more sensitive.
That's clear. Thank you. But some listeners might say, if rates only nudge higher and earnings stay strong, maybe equities can absorb it.
That's possible. But again, we're not forecasting precise outcomes. We're weighing risk. The challenge is that earning strength is less certain in a cost pressure environment. The edge disappears if you assume both stable earnings and low rates.
I want to put a pin in something. You've been consistent about margin of safety. That's your gravity center. In this environment, what does margin of safety look like without telling people to buy or sell?
It looks like demanding a valuation that assumes conservative outcomes. It means prioritizing balance sheets and stable earnings over narratives. And it means avoiding the temptation to react quickly to every headline.
That's solid, but I'm going to push once more. What would make you change your mind? What signal would tell you that the market is right to stay calm?
I would change my stance if I saw two things: evidence that inflation pressures are fading decisively, and that energy prices are normalizing without disrupting supply. In plain language, if the fever breaks and it doesn't come back.
And what's the earliest warning sign that your view is correct, that the calm is false?
A sustained rise in real yields and a widening of credit spreads. Those are the market's way of pricing risk. If those start to move in tandem with persistent energy strength, the repricing is underway.
Again, translate for the listener, real yields are like the inflation-adjusted cost of money. If that climbs, it hurts valuations. And credit spreads are the extra interest companies pay to borrow. When that rises, it signals stress.
Exactly.
We're in a contested episode, and I want to keep it grounded. There's a temptation to declare a verdict, but you're saying the responsible stance is watchful.
That's right. Discipline and analysis protects against error.
Before we move to the watch list, I want a quick historical reference. You mentioned early 2022. Is there another moment this reminds you of?
2007, in a different way. Back then, the early signs of stress showed up in credit while equities remained calm. It wasn't an immediate collapse. It was a slow repricing that suddenly accelerated. The lesson is not to ignore the quieter warning lights.
That's a sobering memory, but it's useful context.
The key is to learn without panicking.
All right, we're not calling it. But listeners need a simple framework going into the weekend. Let's build a watch list for Monday. I'll tee it up. You give the 3 items.
Go ahead.
What are the 3 things to watch when markets reopen?
First, rates. Watch whether markets reprice the terminal rate after the next inflation data. If real yields drift higher, that's a signal of tightening financial conditions. Second, energy. Focus on crude volatility versus spot strength and any developments around the strait. If volatility stays low while spot stays high, the hedging vacuum risk grows. Third, megacap sentiment. Keep an eye on growth leaders like Tesla versus energy and defensives. If dispersion widens, it reinforces the caution signal.
That's clear and actionable without being advice. Thank you. And let's do our one takeaway. If listeners remember just one thing from tonight, what should it be?
When inflation is already sticky, an energy shock is not a side story. It changes the math.
Bernard Gray, always precise. Thanks for joining us.
The rational investor respects the math, even when the crowd doesn't.
Thanks for listening to Capital Sound. We'll be back when markets reopen Monday. And don't forget to catch our weekly market wrap this Sunday for a full recap of the week. Have a steady Friday evening, and goodbye.